When the green line goes up, it means small speculators are getting increasingly bullish. When the red line goes down, well, guess what? It means the commercial hedgers, the guys we count on, are getting increasingly bearish. So what happens now? Okay, now look at this chart. We're seeing this precise pattern in the 30-year Treasury's futures, okay? The small speculators representing the public have gotten increasingly bullish on long-term Treasuries, while commercial hedgers, mainly the banks, have been dumping them left and right. In a situation like this, somebody has to be wrong. And according to Williams, it's usually not the commercials. Who do you think has a better understanding of the bond market, the public or the plutocrats? My money's always on the plutocrats. There's another way to look at it. Get this. Check out the daily chart. The blue line here shows the on-balance volume. And one thing I love about Larry, he is a teacher, and I got to teach his teachings. This is a cumulative indicator that measures volume flow, adding the volume on up days, subtracting the volume on down days. Remember, for technicians, volume is like a polygraph. It lets you know when a move is telling the truth. If something rallies, but there's no follow-through from the on-balance volume line, it tells Williams that that rally will likely be short-lived. Sure enough, when you look at the rally in the Treasuries earlier this summer, okay, the bond prices went to new highs, but the on-balance volume stayed flat. For Williams, that's still another sign that these levels will likely prove to be ephemeral. Flat, up, don't trust it. Put it all together. And he thinks we're going to be looking at a big downtick in bond prices, which translates into a significant rally in long-term interest rates, which means rates going higher. Now, you can read that as a sign of strengthening the economy or a sign that the Fed needs to tighten because inflation's flaring up again, or simply a sign that there's going to be less foreign money flowing into our bond market. But the bottom line, the charts as interpreted by Larry Williams suggest that long-term Treasury bonds are about to get hammered over the next couple of weeks. And you better believe that will have negative consequences for the stock market, which is why I just went through all these charts, because it often presages rate hikes from the Fed. And after this big spike and record high after record high after record high, that's the last thing we want to see right now.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.